Today's panel is about how much you're worth and how accurately you value your studio and games. First of all, I'd like to introduce the panel, or let them introduce themselves actually, with a very short introduction. So going from Johan here.
All right.
Go.
So my name is Johan. I'm currently the GM at Kabam Montreal. Kabam acquired our studio in 2019, and I'm here today having a great time at Pocket Gamer, meeting tons of new companies that we could maybe invest in or maybe buy, or all kinds of fun stuff.
I'm Shum, the MD and founder of Agnitio Capital. We've been around since 2003, exclusively focused on the games industry, specialize in working with game founders in really kind of helping them figure out what they want to do, whether it's potentially sell, whether it's potentially raise some money, or sit back, relax, and put out the next big hit title.
Hello, my name is Barak. I'm the CEO of Murka Games, European game developer, specialized in social casino, and recently we started also to develop casual games.
Hi, my name is Marina Andersson. I'm head of M&A at Stillfront Group. I've been with Stillfront Group since more or less exactly 3 years ago. Since then, we've grown the number of our studios from 11 to 22. So I've been having a lot of fun with Stillfront. And before I joined Stillfront, I've been doing M&A advisory and investment banking, more or less like Shum.
All right, hey everyone, my name is Kim. I'm a studio guy, so I released my first game in the 90s. Spent time at PlayStation, shipping PlayStation 4 in the US. I was heading studio for King, managing the Pet Rescue franchise. And then I did a 5-year stint with Paradox, working on the strategy side. And right now I'm trying to figure out if this whole investment thing is fun on my own. And I think on this panel, I'll probably represent more the buyer side. So what happens when you actually bought it and integrating it.
Thank you. And I'm Simon Prytherch. I head up mobile division at Gamigo, new mobile development. I've also been on the seller's side and sold studios myself, but now with Gamigo, I'm on the buyer's side where I part of their M&A team. So first question for the panel. Whether the studio's in talks around M&A or even looking around for a publishing partner, how do they value their studio? How would you advise they value their studio or their game? Shum, you want to go first?
Of course, I knew you were going to select me. I guess there's many things, right, that you can look at to value a company. It could be financially driven, revenue, profitability, key performance metrics of your game in terms of, sort of retention, DAUs, conversion. So you have all of those kind of very, I would say, fact-based type indicators to value your company. But then there's other things, intangibles, right? How amazing is your team at perhaps building a unique piece of tech? Are you guys experts in UA, in live ops? What about growth? How fast are you growing? Did you just release a hit title and it's scaling incredibly rapidly? So with the right partner, that game could grow 10x. So I'm not trying to be evasive here, but I think there's too many metrics to really look at. And I'm sure a lot of people in the room are probably asking themselves, well, I just read about this deal where this company got a 20 times EBITDA multiple. Why isn't my company valued at the same multiple? And as somebody who's been practicing M&A for 25 years, it's really hard to compare one deal against another. There's so many intangible and specific factors that relate to each specific deal. So of course there's the general kind of accepted revenue and profitability kind of multiples that you see out there that public companies are traded at, right? So in the industry, the averages are anywhere from 2 to kind of 4 times sales. That's your current year sales, and then EBITDA can range as low as 8 and up to as high as 25. So it's a really broad range of just publicly traded companies and where they trade at. And again, I think when you're applying it to private companies, there tends to be a discount because of size and scale compared to the public companies.
Kim, do you want to give a
Well,
seller's perspective?
yeah, I mean, so when I worked at Paradox, we acquired 5 companies. I think we looked at hundreds. I think obviously we looked at the whole multiple and whatever the growth was, but Paradox owned and still owns a niche. So for the strategy there, every company acquired was to maintain the #1 leader spot in that space. That was the whole idea. And so everything looking at long term. So obviously it was partly an acqui-hire, but I think the goal was always to get studios on board who can make sure that Paradox was still the owner of that niche in the long term. And if that was a great deal or a poor deal in the beginning, as long as we thought in the end that studio would deliver to the whole, then that was a good deal.
Yeah, so getting back to your question about, I think that from the seller side, it's very important to look at the potential partnership, how it can help you grow, how it can help you improve your weaknesses, and how together you can become a one strong company that will actually accelerate the growth. So usually when we're talking on the seller side, if they have more than one opportunity for acquisition, I think that we need to look at the synergies and also about the culture, because many mergers are falling on the merge side and because of the culture difference. So I think that it's very important to see that actually you can run together for the upcoming several years and work together and grow your business dramatically faster rather than being and staying a standalone. For me, it's one of the most important things.
And just to build upon what Barak just mentioned, I would like to say that, of course, from valuation point of view, so if there are synergies and good collaboration potential, this buyer who sees a lot of synergies potential and good value building opportunity will be able to also offer higher price, and that's natural.
The angle that I've taken on this, more on the sell side, and like as a founder, you're actually quite emotional when you're about to make a deal, right? Like you're about to get a boss. So when we looked at it, for example, we used that as part of the call it, and it had to be baked into the price somehow, that we were going to give up that freedom that we had. Even if you're still able to operate autonomously and creative freedom and all the stuff that we care about, you still have somebody that you answer to now that is not your wife, right? Like it's something that we made sure to factor in when we created sort of the value that we thought we were worth. Obviously, there's a lot of metrics and stuff, but for us, it was really important that we felt that value.
So a lot of you mentioned synergies and how that affects valuations, and in order to unlock the real potential of a deal, then you need to find those synergies from both sides. Can you give any examples that you can talk about here where where those synergies were important in a deal, and what were the companies involved and how did that affect the valuation?
Well, probably I can mention one, which a deal that Stillfront has done together with Shum on the other side. But something that we show in each presentation, I think, of our capital market days, it's our studio located in MENA region, Babel. So they are very, very successful in publishing in MENA, and this is competence that Stillfront didn't possess at this point of time. So it was very value creative for both Babel to be able to scale within a global company, and for Stillfront because they added something that was very unique for us, this knowledge in the market, how to localize, how to publish games in MENA. And well, so I will not go into numbers, you can see it in our website and slides, but this is a perfect example of value creation. Also, very recently we acquired 6 Waves, which generate all their revenues from Japan, actually. They're headquartered in Hong Kong, but the team has great competence about publishing in Japan. And this is still to come, but this is also what we hope will bring a lot of synergies, because this is a competence we didn't have within Stillfront family.
Yeah, there's different types of synergies as well. We found obviously a tremendous benefit from not having to do some of the more kind of boring stuff like admin and finance. And that has been a great motivator for us. We get to still continue to make and develop games and focus on what we're really good at. So it could be as simple of a synergy as that. Like you might not need to integrate a bunch of tech and stuff like that. It could just be as simple as somebody taking care of some of the things that has maybe been dogging you for a few years as an entrepreneur.
Yeah, I mean, I think you know, maybe not answering your question directly, but again, with a lot of experience, personal experience, I can tell you that if both the parties, buyer and seller, aren't really committed, or if only one is, the potential for those synergies to materialize is pretty low. So there has to be a clear commitment from both sides, particularly if those synergies involve real strategic value add. If it's collaborating on user acquisition, live ops, focusing on maybe specific development capabilities, etc. That knowledge transfer and know-how, that takes time, and that takes a lot of additional resources. People have their day jobs to fulfill, and so there either has to be an integration team, a post-merger integration team that maybe the buyer has allocated to this specific particular project of integrating this new company in, and has all these additional resources. So yeah, I think that's when the potential for synergies to succeed is just greatly enhanced if you have a real plan, a real post-integration plan.
Barak, did you have anything to add to that?
No, I really agree about the commitment part, because then to coordinate the expectation, yes, to really drill down on the details and to understand what does it mean, how the synergies will work, and how the execution will actually be in the day-to-day. I think it's very important in order to come with a real good faith and really to make it a successful for both sides.
What I'd like to ask about next, to lead on for that, is how you go about searching for your ideal partners. What methods do you employ in searching for potential companies to acquire?
Meet to match. Hashtag.
Great plug.
Well, not to be kidding about that, well, it's always good with meet and match, but for us it's very important with our internal network. So our studios are actually very active and interesting to contribute to finding new studios and new companies that would be a good fit with Stillfront. People are passionate about that. So of course we are doing some kind of like attending events and doing own desktop research to find good partners. And then we have very good friends like some bankers and brokers who know who we are looking for. And there are always certain criteria for us, for example, as a company. We always want to see profitable, well-managed companies growing. So this is one criteria. Then we want to see entrepreneurs who have competence within building, developing, and scaling successful games. We want to see games that fit our portfolio of long life cycle games. And then we want to see management teams who want to contribute to Stillfront, who want to stay with us. And then it's very important, of course, with cultural fit. So that's what we want to find normally.
Well, maybe I'm old school, and this whole M&A space has been crazy for the past 2 years. But I truly believe in just mutual respect of the product. So if I play your game and I love it, and you play our games, and you love our games, and we want to be part of the same family, I think we're off to a great start, because then the fundament of why you want to work together is clear. You love each other's products, and I think that's a good start. And then all the other things comes on top of that. Of course, there needs to be a financial deal and all those things, but maybe again old school. But I like the part where I really love the games, and we love their games, and it's a mutual agreement.
The lead generation that you're talking about is what is, I mean, why we're here to a large degree, right? Like the idea of discovering something that and maybe see something that maybe is not in the papers, or maybe they're not up in front. There's certain people that have a public profile and stuff like that. It's extremely rewarding. Like when you actually see something and you're like Kim is saying, like you see a demo or a prototype and you're like, wow, this has like some serious potential. And one of the most fun things in the world is then to go back and share that with, let's say, with the rest of the management team, and maybe start engaging people. But you have to be excited about that opportunity, and it's often very, at least for a part, very tactile, like something that somebody's showing you. And that's been one of the biggest challenges over the last 2 years. It's just like getting that connection through Zoom. It's just not the same.
I mean, I pretty much agree with everybody here. The only thing I'd add is, the 2 years that we haven't really had a chance to get out, travel, meet people, like this event, it kind of forces you to do a lot of desktop research. So I've had to force myself to learn about Web3 and blockchain, and get on Twitter feeds, read numerous posts that I have no idea what they how to follow them, understand them, etc. The jargon, vocabulary, and it's been eye-opening because it tells you how much you actually don't know about what's really going on in that space. So it's a very humbling experience, but I think there's a tremendous amount of ways in which you can identify companies or people out there, whether you're a buyer or seller, that you could have some sort of relationship with.
So I want to take advantage of the fact that we've got people from the seller side and the buy side here. How does the process differ from the buy side and the sell side from your perspective? Kim, do you want to go first on this one?
No, not really.
Or Johan?
I'll kick that off. I mean, as a sort of founder, it is completely. Usually start off in a completely different angle, right? And you think you're fairly well organized until you meet somebody whose job it is to extract that information from you. It's just a completely different, like your life looks like chaos, right? Like once you start putting together, let's say a data center with information, and you've organized it in a certain way, and it might not be at all what that the company or person is looking for. So it forces you into a space that you might not be super comfortable with at first, and then you got to repeat that a few times, ideally not, but most likely. And it becomes another learning experience. And I mean, I'm not here to pitch anybody's services, but that's where the value of the services that a broker or an investment banker can offer. So if I look back on the experience, as somebody who's running a games team, you're usually the producer, the executive producer of the game as well. You might have several. You might be running the testing crew for all that matters. Like you have a day job, and so that entire like sell process is extremely tiresome. The other angle I was going to mention too is like you might have started off with looking for a publishing partner, and then the publishing partner said like, well, what about making a deal? And then you might have to change your mindset again on what you actually need and what you actually want to accomplish. Yeah, so that's one of the things that we saw, at least from the sell side, becomes a bit of an eye opener.
If I can add something, that I really agree, and I do believe that the process has changed dramatically in the last few years. It was originally very well organized and well prepared and so on. And today we see, especially with the smaller studios, that it's really about loving the product. You see the product, you approach, and then you start discussion. It's not necessarily that the seller or the buyer well organized before the process, and then you start starting and see what is important for you. Also, for the buyer side, it's very important to focus of what really important, not just coming with many questions that sometimes can be really out of focus and make the seller side burn a lot of calories, which is not helpful. And I think that that's what we saw in the last 2 years, especially when everything was remote. You cannot meet the people, feel them, so it's all about the data sharing and be focused on what's interesting for you, which is, I think it's changing all the time to become a shorter processes that are more focused on what is important and really to the point, rather than collecting tons of information that is useful, but it's less serving the point.
Yeah, we were one of those guys who did all of that collecting of information. Our commercial DD document was extensive, took forever to fill out. We did, though, for our side, when I worked at Paradox, it was very helpful because you can easily get caught up in what you get in the relationship with a founder or a game, and it all looks so amazing, and you kind of miss out on a lot of things. And I think when the space has moved so fast, it gets harder, I think, to make a good deal. And I think that's why also relying on the the multiple where you can grow is more common rather than actually the long term, as I see it. But so we had like 100, like day 100 checklist. So once we acquired a company, there was quite a bit of steps. So it doesn't just end in the whole DD process. Once a company is acquired, there is a bunch of things that needs to happen to integrate regardless of level. So it is a tedious process, and usually there's a clash between corporate large companies and smaller entrepreneur-driven.
Chaos. What I wanted to add to what's really cool with all the attention that it's getting in media is that I think founders today are getting way more educated on what they need to present. If I look at just the meetings that I've had today, which has been great, like people know the lingo, they know about all these things that we sort of learned through the process, and what let's say an investor or somebody looking at buying a company, what they're interested in, they're now part of a pitch deck for a game. Like, this is our studio, and they already talk about all the key company KPIs, the key game KPIs. I don't think we saw that like 2 years ago when people were pitching games. Like, now it's part of like the about us profile on how much money they raised, like who's part of their investors, etc. So the profile and how we present ourselves has changed as part of that.
I'm not going to add much because I think everybody here kind of belabored the point. I think it just helps on the sell side if they are prepared, right? If you're going to run a process which is going to involve many buyers just for efficiency and speed, it's just going to help a lot if they have their documentation ready, so then they can run their studio as opposed to get distracted by a process.
I wish I'd had better advice when I sold my first company, I think 14 years ago, and we didn't get a very good deal. But I definitely, if you're too emotionally tied to your game in studio, it becomes really important to get some advisors in that can do the deal for you. Anyway, looking back over the last 12, 14 years, especially since the launch of Android and iPhones, and then the access to capital, how has that changed the way studios are valued?
Maybe I'll take a stab at that. So I think again, back if we go back way back, let's say, and we're talking about almost a pre-mobile evolution, or maybe right at the emergence of it. A lot of metrics that I mentioned earlier, KPIs of a game, whether it was retention, ARPDAUs, DAUs, conversion rates, none of those really meant anything. So those are all new metrics that now can be placed to value games and indirectly studios. So I think there's a lot more metric-driven measurement type of I guess benchmarks you can use to value studios today. That being said, on the flip side, you have this new emerging blockchain world where valuation. I mean, it's really hard. I mean, you're promising this incredible future, and it kind of reminds me of the emergence of free to play when you didn't have any tools, any sort of metrics to determine what studios could be valued at. So you get these really lofty valuations that are stratospheric and aren't really based on anything. So yeah, I mean, it's whilst you have a very established way of valuing companies, particularly public companies, or even smaller private companies that are even PC or mobile, there's this new emerging landscape that doesn't really have any clear metrics.
I think also, so as times passes, it's more similar situations and more similar transactions to compare with, right? So, and the industry has been very fragmented. It has seen quite some consolidation, and more consolidation is to come. And the more transaction there have been, the more situation you can compare yourself to. So I think that also impacts the valuation.
So, I mean, the access to capital has changed dramatically. And again, Shum had to mention blockchain. We're not going to talk about that right now. But even in free-to-play mobile, there's been just an incredible progression, even compared to like when we started raising money, when like getting companies to pitch it, night and day today. Like if you had asked me 5 years ago, I'd be like, oh, I'd like kind of guess, a handful of guys that I knew I could talk to. Today, it's like there are, there's some syndication going on. There's all these like early stage VCs that are extremely educated and very sharp, that just you have that instant connection, and they're able to say yes or no, like within like, I wasn't going to say minutes, but they're very quick on being able to judge where you're at. So I can't think of a better time to actually start. And there's also these clear exits. There's the clear interest. You hit, let's say, 30 people, and you're an incredibly interesting acquisition target all of a sudden. Like it didn't used to be like that. So I think from an entrepreneur point of view, it's a great landscape, but it's also, like I said, it could be challenging if you're just starting off that conversation. So the advice has always been like, always be selling. Like whether you need the money or not, you should always be out there and promote yourself.
Yeah, I think you can summarize this. Sorry, it's maturity, right? So the industry is maturing, and I think it's duly because all of you are building successful games, and so that that creates this ecosystem. Games is the largest entertainment industry out there, and it will continue to grow for a very long time. So I think success creates more capital, and it's a good spiral. I mean, it was a conference like 10, 15 years ago. I remember I was walking into the conference and doors opened up and there's like 50 people in suits coming up and they're all smiling. And I was like, what the beep's going on? Why are those people here and why are they smiling? This is games. We were kids in t-shirts. And I looked in and it said on the big screens, like, invest in games. And then I understood, okay, so there's actually money coming into this space now. That's 10, 15 years ago. And that was the first thing for me where, okay, so this is happening now. We're actually becoming successful. So the outside is looking into the game space saying, okay, maybe we got something here, right?
Okay.
Everything been said.
All right. That question about access to capital has, as you say, been driven by people's exposure to exits. There's more and more games companies that have come to the stock markets. And if you look back 10, 15 years ago, there's only a handful of large global publishers that were on the stock markets. But now you have all of these games companies and games related companies on the stock market. What I want to know is, there's been a lot of volatility in the stock markets in the last few months, and most of it's downward in pricing. How has that volatility and price correction affected the M&A world valuations?
Well, so obviously the listed companies, they saw this correction in the first place, and M&A process is always like several months, so you need to decide, make up your mind, probably find a broker who will help you, and then prepare. So it takes some time to adjust. So, and in my view, so the correction has happened in the public market, and already now we've seen that happening in the private markets as well. So you can never, it's always very hard to predict, but some adjustment has happened, and how it will develop going forward, we'll see. But that's my take on that.
By the dip. I think it's a really good time to when you're as a CEO of a company. This is a great time to decide if you put the pedal down or if you light up. You know, the natural reaction is probably, oh, we got to slow down and watch what's going on. It's also a great opportunity to accelerate. And if I look at what's going on with Netmarble and Kabam today, it feels more like we're pressing harder than the opposite. It's like there's an immense opportunity, regardless of the emotions in the stock market. It's more like troublesome to see some of these like really aggressive companies like hit a little snag. But I think it's a great time, and it talks a lot about like what the leadership and how they see the business, if they see it quarter to quarter, or if they see like Kim was talking about, and if they see it in the long term.
I'm just going to state some facts. So 2020, even despite COVID pandemic raging across the world, was one of the most successful M&A years in the games industry by announced deal value, full stop. 2021 was even larger. We're not even to a month and a half into this year, and it's a record year. Of course, principally driven by 3 large mega deals, but still, when you talk to equity research analysts, when you talk to other industry visionaries, they're all sort of forecasting 100 billion plus year of announced M&A deal activity. That is one of the largest industries in the world by announced deal value, full stop. I mean, it's incredible, utterly incredible. So, I mean, I don't really think it's relevant to look at whether there's volatility in the markets or not. I think that's just, to Johan's point, investor ignorance. I think that they just don't understand how fundamentally large and transformative games is as an industry, and they're the ones missing out. They're incorrectly applying discounted valuations to an industry that's growing on a CAGR of 10-15% overall every year, and it's 3 times the size of Hollywood. When I tell myself these facts, I get frustrated, as you can see, but what you see right now in public markets makes no sense. And I mean, even Marina and I have had this discussion. I mean, it makes no sense to me. It's severely undervalued.
Just to add to that, I believe that it's actually can driven to accelerate the search for a good growth opportunity for companies, and to find the next innovation, the next hit, and actually it can eventually contribute to accelerate the potential sales that will come. And I agree with the predictions that 2022 will be even better from that perspective. And as the space will become more mature, so the volatility will also go down, and it will come to stabilize, and we'll get more trust from the public and so on. So.
Yeah, because strong fundamentals are still there, so, and consolidation will continue. There will be more M&A, so there is some correction now, but the fundamentals are still strong.
Like all curves, they go up and they peak and they go down, and then they normalize and they start growing again. It's every curve out there goes through the same pattern. It's the same thing here, and also on Shum's fact thing. So there's 3 billion players accordingly in the world right now, and it used to be 200 million like 15-20 years ago. There's 7.7 billion people in this world. It's supposed to be 10 within 50 years. All kids growing up today are gamers. engagement KPIs are going up across the board, monetization KPIs are going up across the board. We're going to see a population of maybe 6 billion players within a few decades, something, right? And they're all going to play more and spend more according to the statistics. So, you know, what other space could we be in who has such a growth opportunity? And obviously, you know, there will be more public companies, higher value, all of this stuff. It's just a matter of time.
Yeah, I was playing devil's advocate in that. And obviously I'm very aware of Zynga deal and the Activision Blizzard deal and the things that have really hit the headlines this year. And I think the games industry is probably it's probably the strongest sector coming out of COVID, and it's proven to be even during a global lockdown. So yeah, I agree with the panel here. M&A activities is bolstered by strong fundamentals everywhere. I realise we've only got 5 minutes left in our session. I want to open up to the floor. Is there any questions here you want to put to the panel? Thank you.
Hi. From both perspectives, I'd be interested in, you know, you talked about deals and motives and synergies and so on, but about the structure of deals, you know, deferred payments, earnouts, taking equity. What are the views on the sort of merits and demerits of anything other than cash up front? Thanks.
That's a great question. Very difficult to answer. It's all about preferences and about your company's ability. In the very end, it has to be feel fair, and whether it's an upfront, and there has to be a connection at one point where the companies meet, like, and really and stay together. And that's probably one of the hardest balancing acts. And you know, and it's kind of cool actually to read about all these public companies where they actually talk, like you know, Stillfront, they disclose a lot of the details in the structure, and it's eye-opening for people. I think it's great because it gives us a much different perspective on what can be achieved, especially if you're a founder and you're sitting by yourself and you don't have the support of somebody like Shum, even if you should. Like, there just gives you a lot of that information on how they look at risk. And I mean, as a founder, I don't look at risk the same way as a Stillfront would look at risk, right? So seeing these creative solutions has been really cool. Like, I wish it would have been 3 years ago.
Yeah, for us, when we're thinking about earnouts and paying an equity, it's about alignment of interest, right? So normally we acquire founder-owned companies, and we do not want founders to leave. We want them to stay with us and help Stillfront to grow. And that's the reason behind earnouts and behind equity components.
I'll probably add something to that as well, in that if you're a founder and you're confident in your forward projections and your forward plans, because it'll de-risk it for the buyer, they can offer you a much better deal on the earnouts. So if you are confident, then go with that.
I was just going to say that.
Any other questions?
It's all crystal clear.
Yeah, I think the summary of it all is that for every deal, well, for every company, there is a partner out there somewhere, at least one, just like relationships. And the valuation is based on who the synergies, it kept being mentioned here, between the buyer and the seller. So if you can make yourself really attractive to just one other company, then you'll get the valuation you want. Thank you, panel.